weekday evening time. We have an incredibly exciting guest with us. His name is Vivek Veda. Vivek is the co-founder and CFO of KrazyBee, which is one of the fastest and one of the most incredible growing companies in the personal loans lending space. And we'll chat a lot more about KrazyBee as an originator of both bonds as well as securitized PTCs very soon. I'm also joined by Raman Chandna. Raman is he's the head of the fund management business at Grip and has pillared the the launch of corporate bonds for us. And my name is Siddharth. I'm the Group Chief Investment Officer and look at all things products and investments for Grip. Thank you so much, Vivek and Raman, for joining.
Hey, thanks, Siddharth. Thanks, Raman.
Thanks.
So maybe we'll kick off with a quick introduction or a recap to what Grip has been undertaking in the PTC space and what we have been doing as a platform, and then we will dive into the opportunity and more about KrazyBee right away. Raman, if you could go to the next slide, please. Okay, so just a quick recap of Grip. So we are, as you're aware, we are a platform focused on democratizing alternative fixed income investments for individual investors. And Grip today holds 3 SEBI licenses. We are fully regulated. All the products that we offer on the platform are also regulated. We have touched now nearly 1,000 crores of investments in little over 3 years. We have processed nearly 500 crores of returns, and we have the support of nearly 26,000 active investors on the platform. So that's where the platform really stands today. If you go to the next slide, please, Raman. We have 5 products that I'm sure all of you have come to love us for. We started with LeaseX, which was our product to securitize operational lease receivables. And last year we launched LoanX, which is also the opportunity that we'll be talking about today. That's where we securitize NBFC receivables, and we also have NBFC bonds that you're all familiar with. BondX, which is a basket of bonds pooled into a single instrument, and InvoiceX, wherein we securitize trade receivables in a single instrument. All the products are listed, rated, and secured by internal or external collateralization. If you could go to the next slide, please, Raman. And here's a quick snapshot of where we stand today. So we have nearly 200 crores of securitized debt instruments. Actually, that number is more like 250 now. I think this was a slightly older number. We have at almost 250 crores of SDIs, and we truly pioneered the product for the retail investors. A bulk of that has come from our 2 products, LeaseX and LoanX. They contribute almost 90% of the transactions that we have brought to the platform, and almost I would say 75% of our products are rated investment grade and higher. So that's in a nutshell of where SDIs stand for us today. And of course, we have 0 defaults. So moving on quickly to what is LoanX. LoanX is essentially it's an instrument that allows investors to invest in securitized receivables of an NBFC. And by that, what we mean is, if you'll follow this pictorial diagram on the left-hand side, where you see number 1, you will see that an NBFC underwrites and provides loans to a pool of borrowers. in lieu of those loans, it expects some receivables. Those receivables are then securitized by the NBFC to a trust, and that trust issues PTCs, pass-through certificates, or securitized debt instrument to investors like yourself. In lieu of the issuance of those PTCs, whatever collections the trust has from the receivables of the NBFC are then also passed on to you in the form of fixed monthly payouts that entail both principal as well as interest, principal repayment as well as interest payment. It's an incredibly established asset class as well. In FY24, it's expected the asset classes touch almost 205,000 crores. And you'll see on the right side an incredible number of institutional investors such as Kotak, Godrej, Citibank, HDFC, ICICI. You think of an institutional investor, and they are there who are actively participating in securitized debt instruments. So in a quick nutshell, where does what is LoanX and what are the key investment highlights? Well, it starts with us picking a pool of diversified loans, and this is usually it could be across several hundred or thousands of borrowers. This pool is then securitized into an instrument that gives usually 12 to 14% return, and it is typically 100 to 250 basis points higher than a comparable corporate bond. And the instrument is also rated by an external rating agency. There is, I spoke about inherent collateralization or security in the instrument earlier. So, it's typically backed by a cash collateral or a security deposit, if you will, and also some over collateralization that provide for ample security. It is RBI regulated. We often list our PTCs. That also makes it SEBI regulated, and these SDIs are held in your demat account. And lastly, only the interest is taxed for the investor, and not the principal payouts. This is a quick sort of snapshot of some recent coverage about LoanX. Mint covered us, and essentially, this page shows that LoanX, if you see on the right side, it shows that LoanX on the return spectrum was more or less in line with the Nifty 50 index fund. And these are, of course, long-term returns, annual returns. And on the risk side, it was marginally higher than a fixed deposit, but significantly lower than invoice discounting or Nifty 50 index or P2P lending. And so, we think it's an incredibly attractive product from a risk-reward perspective for our individual investors. Okay, with this, I'll actually hand over to Raman. And just for context, we have also undertaken corporate bonds with KrazyBee, and now we have brought a PDC transaction for our users. So over to you, Raman, and to Vivek.
Sure. Thanks for this overview. Hi, Vivek. Vivek, thank you first and foremost. Thank you so much for joining us here and giving us your time. We all know that what you've built over the last 4 or 5 years at KrazyBee is just phenomenal. The growth that we've seen at the company level is just amazing. I would just basically want to start with just the primer that would love to hear from you, about your journey and about KrazyBee and what kind of products and services do you guys offer?
Sure. So hello, everyone. Very good evening. So quickly, I am Vivek Veda. I am the co-founder, CFO of KrazyBee, which is our NBFC, and we run a brand called KreditBee. So we started this journey way back in 2016. The idea at that point of time was that, we saw a huge amount of population which is not served by banks or other large NBFCs. You can say mid-income, middle-class population. The reason is twofold why large NBFCs and banks are not serving is this population was that if you look at typical, loans from banks or large NBFCs, the idea is since there is a manual underwriting which is involved, they will be looking for a minimum ticket size what they can give to the customer. Now, at that point of time, either the customer requirement is really less and he don't want a larger ticket loan, or second is eligibility is of a small ticket loan. So we thought that if we can do that, and if we can tap this, say, 400 million population, which is like mid-income, middle class, then there is a huge opportunity. However, the challenge what we face that if we want to do the underwriting in a similar fashion, which is like a manual underwriting, then it will not make a business sense for us to run this product. So we thought that, okay, can we replicate it in a digital format? And we started building our tech stack. Over a period of time, from 2016 to 2018, we started giving loans to people who don't have any financial footprint. We started testing the markets. We started testing the credit cost and so on and so forth. And once we get the comfort, we launched this product to the mass public, which is like young professionals, salaried or self-employed. From there on, there was no looking back. Today, where we stand today, we are one of the largest digital lender in the country. If I have to talk at a group level, we get around 50,000 unique applications on a daily basis. Now, think of a situation if you have to underwrite 50,000 applications manually, it is not humanly possible, or you need an army of people. So what does that mean is, when 50,000 people apply on our platform, as and when they are applying for the loan, on the back end, there is an underwriting which is happening. So our approval rate is around 10%. So 5,000 people from this new cohort which is coming to the platform will get loan. And around 25,000 repeat customers on my platform will get loans. So every day we give loans to around 30,000 customers. So when we started the journey, we started with like 6-7 people from an incubation center. Today, we are a team of around 3,200 people on our payrolls and another 600-700 people working with the various agencies. Till now, we have done a cumulative disbursement of around 50,000 crores to around 1.2 crore unique customers. Today, our AUM stands at around 8,000 crores, which is my platform plus my NBFC. On my NBFC, the AUM will be somewhere around 4,800 crores. So what does that mean is, and it's widely spread, so I'm talking about, say, 40 lakh customers generating a AUM of 8,000 crores, what I'm talking about. So, So as and when we started growing up, we started increasing our ticket size, increasing our tenures and whatsoever. So today we give loan anywhere between 3,000 rupees to 7 lakh rupees, anywhere between from 3 months to 36 months. Our average comes to around 22,000 rupees as a ticket size and 9 to 10 months as a tenure. So that's where we stand today. We are a systematically important NBFC. What does that mean is we get our inspection done from the regulator. We have to submit our returns and whatsoever which is required by the regulator. Another key things what one has to look at, that we are backed by marquee investors, which is Premji Invest. They are that's the investing officer of Azim Premji, which is Wipro founder. Then Motilal Oswal, Advent International, which is one of the largest PE fund in the world. Motilal Oswal, Advent, ICICI Bank, Mirae Asset, and TPG. So again, around 7-8 marquee investors have backed us in this journey. We have closed our Series D round a year back. We are sitting on a NBFC net worth of 2,000 crores, group net worth of 2,700 crores, a leverage of at a group level of around 2,700 crores. So 1:1 leverage. Another thing, how we differentiate ourselves from most of the other fintechs is we became profitable in very early life or very, very, very early stage. So in the 3rd year of operation, we started showing profits. And if you look at this financial year, which is 23-24, we did a group level disbursement of 20,800 crores, top line of 2,000 crores, and a PAT of around 285 crores. Yeah, so that's the journey. So we are 3 founders, Madhusudan Ikambram and Karthikeyan. They come from the tech background. Madhu is from NIT Surathkal and then his MBA. Karthikeyan has done his undergrad and post-graduation from National University of Singapore. I'm a chartered accountant, was a banker in my previous life, have worked with Edelweiss, Espirito Santo, HSBC. Last job was with Society General, after which we joined hands and started this company.
No, thanks so much, Vivek. I'm actually cutting down 10 of my questions, other questions that I had here, because your introduction included most of my questions on just the intro. But thank you so much for giving us this insight into your company. It's amazing what you guys have built. Some very good investors, marquee investors in Premji and Motilal Oswal. I actually wanted to check with and understand from you. And you mentioned very briefly about 25,000 loans on a daily basis, etc. One part is the tech part, obviously, and you've standardized that. The other part is that what primarily is your target segment, right? What kind of CIBIL score that you look at for people? How does this tech work around that? And what kind of safety measures do you take in terms of recovery of this money? When I say recovery, or getting back any of these loans, right? So
Raman, a very interesting question. So let me talk about tech stack first. So see, how it works is that today whatever data is available to any other player in the market, the same data is available to us. How it works is the more and more profiles your tech engine, your risk engine, rule engines have gone through, the more and more expert they become, right? And the more and more better credit quality customers you start giving loans to. So in that light, if you look at, we have, as I mentioned, 1.2 crores unique customer has taken loan from us. I have around 90 million app downloads, right? So what does that mean? Says that my tech engine, risk engine, rule engines have matured enough to differentiate between a good customer and a bad customer. And that's how we started this journey. Now, again, the product what we have built is a kind of a gamification product. So what does that mean is if Raman is coming to my app to take a loan, and he's a first-time borrower, I will take some data from him, underwrite him, and might give him a 3,000 rupees loan or a 4,000 rupees loan for a period of 3 months. Now, what Raman has to do is start repaying it. Now, once he repaid that loan, there are two options. He can be eligible for another loan, or I will ask some additional information from Raman, and then I can increase his tenure and limit. So that's how we start upgrading the customer over this journey. So that is part number one. Now, part number two, again, when we started this company, the idea was that we will build this tech stack. We will have like 300, 400 people, tech team, finance team, and then we will disburse the loans and try to do whatever, try to build around the algorithms and everything, and try to recover money through whatsoever tech capabilities we have built in. However, we realize that collection is the name of the game, and somewhere that huge collection capabilities need to be built in, because that is something which will give comfort to the investor set, be it your equity investors, be it your debt investors. That will give comfort to rating agencies, guys, whenever they rate you. That will give comfort to all the traditional banks, traditional people who will be lending money to my NBFC. Sure. So we started building the collection capabilities over a period of time. Today, we have an in-house collection team of around 1,200 people. Now, how we look at it is 85% of my collection happens without any manual intervention. But every month, I have to collect EMI from, say, 40 lakh customers. So for the balance 50%, this kind of capabilities is required. Again, if I have to allocate it to the individuals to do the calling and recover the money, it is not humanly people, and I might require another 3,000, 4,000 people. So we have built a lot of tech stack around it. So what does that mean is there will be auto calling, there will be robo calling. An agent can engage a customer for 1.5 minutes without, or a system can engage a customer for 1.5 minutes without customer realizing that he is talking to the person or a computer, right? So that's kind of technology capabilities what we have built over a period of time. With around 1,200 agents working on our payrolls, another 600 agents working with various agencies. So that's on the collection thing, and that is something which give us an edge as compared to many of the other fintechs where they are struggling to build these capabilities on the collection side. Sure. So yeah, I think what was the third question, Raman?
Yeah, so my other part of that question was the fact that you mentioned very briefly that when a customer first comes in and he doesn't have a track record or history of any taking of any loans in the past. What happens if a customer who has some history, etc.? Then in that case, do you start at a higher ticket size with them first? That's
exactly.
One.
Yeah.
Yeah, please.
Yeah, sure. So Raman, now I can just give you an idea of my customer base, and then I can touch upon this question. So you asked specifically on the bureau. So when we started this journey, say 2 years back or 3 years back, up till 2 years, 3 years back, around 35 to 40% of my customers were new to credit, and the balance 60% were, say, 700 plus CIBIL score. However, if you ask me where my book is sitting today, around 90% of my customers is 700 plus, around 8% of my customers are new to credit, and 2% of the customer are in transition. Sure. Out of 90% of the customers who are 700 plus, around 50% of those customers are 750 plus, right? So that's where it starts. Now to the second question, yes, this is something what our risk engine, rule engines are capable of. So for example, Raman coming to me as a first-time borrower, and Raman is a salaried, he will get a higher limit as compared to Raman who is coming as a self-employed. So that is one differentiate, because our systems and past data says that salaried people are less riskier than self-employed, and you are a first-time borrower. Sure. Now the second scenario comes, Raman, he is a customer with say 700 plus CIBIL score, he is salaried and so forth. Yes, you have to give me additional data, you have to spend longer time on my app, but then you are eligible to take a higher ticket and higher tenure loan. So again, all this risk engine, rule engines are built in, where few risk and rule engines will decide whether we should give loan to Raman or not. And then few risk engine, rule engine will decide what kind of loan and I should take an exposure on a particular customer or Raman in this example.
Yeah. So Vivek, typically it's considered, given the fact that, what you explained, it's considered that, this kind of lending is slightly more riskier than, lending via a bank, etc. What are the NPA trends, whether on gross NPAs, net NPAs? What are the kind of NPA trends do you generally see in this business? And I'll come to the regulatory question later, but, what are the general trends that you see?
See, definitely, Raman, I'll say that, this customer might be a bit more riskier than your traditional lending, which is backed by a asset or something. But again, if you look at, in that case also, the default rates and all those things might range into the level where what we are talking about. The only idea is that there is a backing of a security, say a house or a four-wheeler, two-wheeler, or whatsoever. Sure. In our case, we are running as one of the best portfolio in the unsecured space. Our GNPA is 2.35%. Our NNPA is 0.65%, as and when we are talking. However, if I have to explain it at a cohort level, if I'm disbursing $100 or 100 rupees loan, around 3.5 rupees of that loan will go bad. So that's the credit cost what we try to build into our system. 1 year back, we were talking about our credit cost will be in the range of 4 to 3.5%. Today, we are talking about in the range of 3.5 to 3%. So that's where our credit cost will shape up. However, one important thing what I want to highlight here, Raman, is that, the median age of my customer is 27, 28 years. Now, think of a situation, if I'm giving say 10,000, 5,000, 12,000, 15,000 rupees loan to a customer, a young customer per se, and then if he has not repaid it, I have all the rights to impact his bureau. Now, think of a situation, at some part in the journey, there is a limited amount of money or resources I can spend for this 15,000 rupees of collection. So at one point of time, I will write off that loan and impact his bureau, because he has not repaid on my platform. Now think of this customer at one point at some point in his life, he will be looking for a higher ticket, higher tenure loan. The moment he will approach to any other large NBFCs or bank for that reason, the first thing they will say is, boss, you have defaulted at a KrazyBee platform, KrazyBee NBFC. You have to go and take a no dues from that NBFC before we can, further take your file. So that becomes a very important tool for us to recover the money back. And over a period of time, we will see that, these customers at some point of time will come back and repay the money. The scenario can be very different if I would have given him a 5 lakh rupees loan, because in that case, even if he has an intention to pay back the money, he might not be in a position. But for 5,000 rupees loan or a 10,000 rupees loan, there are high chances that at some point of time, the customer will come back, pay back the money, take a NOC from us, and make sure that he is eligible for a higher ticket, higher tenure loan in the journey.
So basically what you're trying to say is the fact that one, they are early on in their life of, working life, and they're taking a smaller amount of loan. Even if they default later on, when they have to take a bigger loan for car, house, whatever, they will not be able to access loans, or they will find it very difficult to access any kind of loan because of the defaulter status that you put in. So very interesting. And I was actually chatting with somebody else also from the same industry, and they mentioned that they've also seen instances in the past that 2 years later people have come in and closed the loans down.
Right.
Right. So while they tried for the first 3, 4, 5 months, and because obviously it's also not very effective for a 5,000 loan, you put a lot of resources on it. But people automatically will keep coming back after a year or two when they are going ahead with it.
Yeah.
Very interesting. Vivek, from a perspective, and COVID impacted all of us and there's an interesting question. How did you guys fare during the COVID period?
Right.
And what kind of, and it can be COVID was one black swan event. There could be another one in terms of if you're concentrated in one particular area. I know that you're working in 36 different states. All of that is happening and you try to diversify, but let's say there's a geographical concentration and there's a 5% book in one geography. Something happens in that region, etc., and then obviously there's higher level of defaults. How do you plan for such situations, one, and what is your modus operandi when that something like that happens?
Sure, Raman. So very interesting question. And, let me start with a very lighter note. Say from 2016 to 2020, one of the questions when we were talking to any of the equity investors or debt guys, that you people have not seen the cycles, right? So we don't know how it will behave, how your book will behave. Somewhere the delinquencies will be very high and all those things. And few of the industry gurus have said that 20-30% of the book can go bad. So that was always a very tricky question, how to answer it. Unfortunately, from 2020, there have been several cycles what we have seen, starting from COVID wave 1, COVID wave 2, COVID wave 3, fintech cycle, fintech crisis, digital lending crisis. Then, somewhere now you can say a regulatory cycle where a lot of rules, regulations are coming around. So let me touch upon COVID, right? I'll give you an idea. So 2020 March, I was doing a disbursement of around 1,000 crore plus. So what does that mean is when COVID hit us, we were at a very decent size. And, suddenly, in April, there was a lockdown and we were not sure how to work around it. And we were not even prepared to give, the collection operation guys work from home option. Because for tech, finance, risk, and everyone, work from home option was available. For collection guys, they work in shifts and whatsoever. So there was nothing available, or they were not unable to work from home. So overnight, we make sure that all the collection guys have laptop and all those things. They are equipped to work from home and so on and so forth. Then for April, May, June, we stopped disbursement and the complete focus was on collection. Now, at that point of time, we realized that, book is not as bad as perceived by the industry gurus. What does that mean is, I'm not saying that I was not impacted by COVID. Definitely we were impacted. At that point of time, if my credit cost was at 4%, the highest loss what we suffered was around 7% in a particular month cohort. So another 300 bits.
Explain in slight more detail what does credit cost increasing means, and
Yeah. So what does that mean is, if I'm disbursing 100 rupees, in that particular 100 rupees, assuming at that point of time, 4 rupees will go bad in the normal scenario.
Okay.
Because of COVID, another 3 additional rupee loss happened on that 100 rupees.
Sure.
So there was a loss of, say, 7 rupees. However, on the earning, if I look at on the 93 rupees, what I have done an earning of 108 rupees. So what does that mean is, net, I made money on that, on the cohort, which has given me the proper returns and so on and so forth. However, the critical part was that from 1,000 crores of monthly disbursement, we stopped the disbursement. Our book ran down substantially. And when we restarted the disbursement, it started from 10 crores of a monthly disbursement. So it was like restarting the complete machinery. Then COVID wave 2, we just slowed it down. There was no major impact. COVID wave 3 was very normal for us. However, how we see it as, yes, it was a painful phase where we had to, we on a monthly basis, we went into losses. But then when we recovered really fast. All our lenders, they increased our limits on our platform, because one of the things what we did was, Raman, at that point of time was, if you look at, there was a good amount of moratorium which was available, right? RBI came out with a circular that all the lenders have to give moratorium. I think we took a stance, since our book run down substantially, we took a stance that we will not take moratorium from any of the lenders, including PSUs. We repaid the loans ASAP. What does that mean is, when the machinery started back, we became their first choice. I still remember people who had given us a check of 50 crores, 100 crores, they doubled the check amount to 200 crores after the COVID. So somewhere, one, our book tested the COVID, the delinquencies were in control. We never took moratorium. That gives comfort to our lenders. And once the economy started opening up, we again scaled it back. Today, we are doing a monthly disbursement of 2,200 crores, which is highest in the digital lending space.
No, wonderful. And great testament to the business that you guys have created. I can't imagine a scenario for all NBFCs, and this is across the board, right? What you guys went through in terms of business up cycle and down cycle when COVID hit at your scale. Siddharth, I would like to bring you in. And would you want to just quickly let's talk about the PTC that we have and how this book ties up and with what Vivek has just mentioned?
Sure, absolutely. Thanks, Raman. And before I dive into the PTC, maybe one of the questions I would ask Vivek is to throw a bit more light on the lending relationships for KrazyBee, and how Vivek thinks about NCDs versus PTCs from their own perspective, but then also if he wears the investor hat, what are his views then?
Yeah, sure, Siddharth. So let me take 2 steps back, Siddharth, and just give an idea on what are the sources of funds, what is available to us as of now. So definitely, I spoke about the marquee equity investors who are sitting on our cap table, and they have given us like $280 to $290 million of equity money in this journey. So that is, since we are a profit-making company, that equity money is also used for onward lending. Now, on my NBFC, we have around 50, unique debt partners, starting from banks, which is like, your HSBCs, private sector banks like HSBC, AU, Axis, and so on and so forth. On a public sector bank, say Bank of Maharashtra, SBI, and then a couple of more. I think all the small finance banks are there. So that is something where we get the lines from the banks. Then on the, that constitute around 20-25% of our borrowing. For the balance 75%, we look at NCDs, money markets, PTCs, and other large NBFCs who come and give debt to us. So for example, NBFCs like Chola, Tata Capital, Mass, Vivriti, and so on and so forth. So these are the pool of capital which is available to us to raise money on our NBFC. Then we do co-lending model also, where we have tied up with around 12 to 13 partners who do co-lending for the leads what we are generating. Now, quickly on your specific question, how we differentiate between PTC and NCDs. So as a borrower, I look at as 2 different sources of capital. We have done a good amount of NCD issuance in our past. However, PTC is something what we have started, say 6 to 8 months back. But again, what we have realized that this source of capital is getting a lot of traction from the investors. So that's where now we will be actively working around PTC transactions. As and when we are talking, there's another large fund house who is looking for 200 crores of PTC with our company. On a risk reward, on the basis of risk and reward, I don't see any major difference between the 2 transactions. On an NCD, there will be a definite return what you will be getting on a monthly basis over a definite tenure of the product, which is generally 13 months. On the PTC, generally it is like a 18 months kind of a product. But since a lot of my customers prepay their loan amount, might be this 18 months product can end up into a 14 or a 13 months kind of a tenure product. with a similar kind of a return. The return might be 25 bips here and there in both the transaction, depending upon the market scenario. But for me, both the transactions look very lucrative from an investor point of view if I have to invest.
Got it. Okay. No, thanks for that perspective. And I think that's a good segue to actually to the opportunity that we launched recently. And I would again sort of iterate that at Grip, our users have invested in both NCDs as well as KrazyBee NCDs as well as KrazyBee PTCs now. I think we have close to 300 investors that have invested across the two asset classes or products by KrazyBee alone. So definitely, a lot of users who like the name and who sort of appreciate the product that we are bringing to them. And so, diving into our latest offering by KrazyBee, this is a PTC which is A+ rated by CARE. And it entails a pool of 4,600 plus personal loans. And Vivek spoke about how that's the core of their business a short while back. Our co-investor in the transaction is Godrej Capital, who's one of the most prolific PTC investors and typically invest from their treasury in PTC transactions. We took nearly 20% of the transaction for our users, and Godrej invested in the balance. This CARE A+ paper offers a YTM of or a pre-tax IRR of 11.8%. It's expected to mature in 18 months and will pay out monthly. So during the first 6 months, our investors will get only the interest payouts, and then from 7th through the 18th month, they will get paid out both principal as well as interest. But also tying this back to what Vivek mentioned a short while back, he mentioned that a lot of his borrowers actually tend to prepay and in the order to sort of build that credit score and that trust with the platform. And so, this is an interesting structure wherein we built in a replenishment period which is for the first 6 months, wherein whatever principal is collected in the pool is actually utilized towards lending again. And that just means that, there can be more excess interest spread in the pool over a period of time for our investors, more security over a period of time. And also, from the originator or KrazyBee's perspective, it also gives them a chance to grow the book and provide a better profit multiple for our investors. When we speak about the security, this paper has a over collateralization of 14% and cash collateral of 6%. The excess interest spread is close to 11%. And we already spoke about KrazyBee. I mean, these December, the numbers we have here are December numbers, but Vivek spoke about how KrazyBee is already a 4,800 crore AUM NBFC, just their own book, with healthy capital adequacy ratios and incredibly low NPAs. If you can go to the next slide, please, Raman. So why do we, in a nutshell, why do we really like this opportunity? I think our benchmark for evaluating every opportunity is really it's based on 3 pillars. I think it should offer attractive risk-adjusted returns. Number 1. Number 2, we should have access to a highly diversified pool of loans. And number 3, the security package is attractive, and we are in the opportunities with a strong originator. And those are the 3 or 4 reasons where why we like most how we select most of the opportunities we bring for our users. In this particular transaction, I already spoke about the return. An 11.8 return is for an A+ paper of this 18-month duration is pretty attractive and at least 150 basis points higher compared to similarly priced corporate bonds. It also pays out monthly, which means that the risk is not back-ended, and in a way it gets amortized each month. The second, reason is the diversified pool of loans with a strong repayment track record. So it entails 4,600 plus borrowers spread across 21 states, 321 cities, highly diversified. These borrowers have a repayment track record of at least 4 months at the time of securitization of the transaction. The transaction also offers a pretty high security cover. So, we spoke about over collateral of 14% and cash collateral of 6%. And while that's the OC and CC at the beginning of the transaction, the weighted average security OC plus CC over the life of the transaction over 18 months is almost 1.34 times the investment amount. So you start with sort of 1.2 times, which is your principal plus OC and CC, and then on a weighted average basis, it's almost 1.34 times, which is incredibly attractive. And talking about again high security, our analysis shows that this pool could default by up to 27% over the life of the investment, and still with the OC and CC present in the transaction, our investors would get their entire principal and interest back during the expected holding period. And just comparing the NPAs that KrazyBee has seen, they've witnessed 2.5%, 3% NPAs compared to 27%, which is incredibly high, of course. We spoke about originator scale already. They are one of the fastest growing and largest NBFCs in the digital lending space, and we also like the fact that there is a institutional co-investor in this opportunity in Godrej Capital that has obviously one of the largest books among the largest books in the country, and they have invested 50 CR. Raman, if you could please go to the next page. Here's a quick visualization of returns. I already spoke about these numbers. You'll see that the line on the top is essentially the principal maturity line, which is the light bluish color. So you notice that during the first 6 months, your principal is there's no principal repayment, but only interest gets paid out. And then between 7th and the 18th month, principal entirely gets amortized. We also spoke about the security cover earlier. You'll notice that the security cover starts at a number that's close to 20% at the beginning of month 1, but then creeps up to astronomically high numbers over the life of the deal as the principal gets amortized. But on a weighted average basis, it's 134% or 1.34x of the investment amount. Here's a quick recap of the pool again. Again, 4,600 borrowers, 760 plus CIBIL score, which is incredibly attractive. And we have truly sort of cherry-picked the loan from KrazyBee's available loan book. The highest concentration from a state perspective is Tamil Nadu, which is 21%, but there's still ample diversification between several states. The weighted average ticket size is 1,51,000 per borrower. Again, which is Vivek mentioned earlier that they provide loans from anywhere between 3,000 to 7 lakhs, and so this is sort of well below the 7 lakh mark that Vivek mentioned earlier, and it means again the pool is incredibly granular and your risk is truly diversified. And we already spoke about the weighted average payment track record of 4 months earlier. Here's a quick look at what this transaction, how this compares to one of the earlier transactions that was undertaken by also by Godrej coincidentally earlier in the year. So on the left hand side, you will see our transaction, which is at 11.8% IRR. It's CARE A+ rated, and so was the earlier transaction rated. CARE Plus, it was rated CARE A+ as well. In terms of how the pool was amortized, security enhancement, the excess interest spread, the tenure, everything is incredibly similar to one of the other institutional transactions that KrazyBee undertook. Perhaps the only sort of key difference I would like to highlight is that we have this replenishment structure in our in our transaction, while there was no replenishment structure in one of the earlier transactions that KrazyBee undertook, where, by the way, they have seen incredibly good repayment track record from the borrowers as well. Go to the next page, please. This is the quick, waterfall mechanism of how the cash flows work. So I think that the sort of the key takeaway really is that, once as the pool throws up cash flows, the KrazyBee receives cash flows from the borrowers. It's first utilized towards repayment of any interest amount due to the investors. During the first 6 months, then it would utilize the balance amount towards replenishing the pool with more loans. But after 6 months, any sort of excess amount after paying out the interest is also utilized towards paying the expected principal for the investors. And then the balance, once expected payouts for the investors take place, then the balance goes to KrazyBee again for onwards lending typically. Okay, and this is a quick slide on Godrej Capital, but I think they need no introduction. We wanted to just talk about them given the other co-investors, but they're obviously part of the Godrej group and have done prior transactions with KrazyBee as well, and highly institutional investor, and present across several markets. So we are pretty thrilled about co-investing alongside them in this opportunity. Yeah, I think maybe before I open the floor to questions, Vivek, if there's anything that you wanted to highlight in the transaction, or we'll throw up a couple of more questions that have come our way.
No, I think Siddharth, I think more or less you have covered everything. Just I want to highlight that in this 8 years of journey, we had we had got around 50 unique lenders on the cap table, and these are all institutions, banks, be it on public side, private side. So that's the kind of comfort what we have built in over a period of time. And that is something which is very unique to a company like us as compared to many of our other competitors. This kind of diversified cap table, be it on the equity side or be it on the debt side, is really unique. And what does it show? That somewhere we have been able to convince both the debt investors and equity investors about the journey what we have built, or the product what we have built over a period of time. Yeah.
Sure. Great. And maybe one of the questions, Vivek, that we had from one of the users was, RBI has been incredibly active, as I think most of the industry participants are aware of, and your smile says it all. They have also been active in coming out with certain regulations around personal loans. How do you see the regulatory landscape? Has it been impacting KrazyBee favorably? Does it mean more compliances? Has it impacted lending in any manner? If you could throw some light on that, please.
Sure, Siddharth. So to be honest, if you look at per se, on a short-term basis, yes, the cost of compliances are increasing, and definitely, we have been very cautious in terms of whatever coming from the regulator have to be followed, have to be implemented to an extent. Whatever we do, we first implement all those things, then we get it checked, verified from one of the big fours to make sure that nothing is missed. So that is one practice what we are following very religiously, that anything and everything which is coming from the regulator, first get it implemented, then get it checked from one of the best agencies available in the country. How I see it on a longer run, if you look at the industry, say 3 years back, there have been a lot of unauthorized, unregulated players who have entered the market, and there was huge interest, huge APRs what have been charged, and somewhere being an unauthorized, unregulated players, somewhere they were competing for the same, but everyone was competing for the same customers. And since they were like easy to get loan from these platforms for a borrower, they were getting attracted without realizing that the charges what they are doing and what kind of collection practices they are followed. Somewhere with the new guidelines, with the tightening, all this competition, all this unauthorized, unregulated players have gone out from the market. So yes, definitely on a longer run, it has benefited where all the regulated players are in the market and they are now competing based on what kind of product, what kind of convenience, what kind of rate you are offering, as compared to unauthorized players who can go and give money at any rate and then can add a lot of charges over and above it, which a customer will not be aware while taking the loan. So that's where it has happened. I think, how I look at it is that it will continue for some more time. There will be few more, tightening which can come from the regulator. I'm not denying that. But in the longer run, it will further help the industry or help the companies like this to grow stronger, right? That's how I see it. Might be there will be a short-term pain in terms of the higher compliance cost, but in the longer run, it will definitely benefit. Industry will consolidate, and for few of the large players, there will be ample market to capture. That's how I see it.
Yeah, no, absolutely. I think, we echo that sentiment. I think the regulations often help the best in class become better and truly sort of gives them an opportunity to differentiate themselves from a lot of the copycats or a lot of the people who are not following the right practices. Somewhere we also look at this product as, while one can obviously compare it to corporate bonds, we also sometimes look at it as an alternative to P2P, where, again, there is, I don't know if that's what you were alluding to earlier when you said unorganized lending in some ways, but I think it's of course regulated in some ways. But, we think that securitizing, offering such securitized instruments with inherent security package is on a risk-adjusted basis, it's definitely a better proposition for retail investors. It would be
Sure. Siddharth, just one caveat. So to be honest, I was not mentioning about P2P because P2P is a regulated entities, are the regulated entities. They are governed by the the license is given by the same, Reserve Bank of India. Yeah. I was talking about the players who don't have the licenses or who are just borrowing the licenses and doing the business, That's where the major problem was coming. P2P is a very different ball game where you get the license from the regulator and then you do the business. It's a very different from exactly what we are doing.
Yeah, no, absolutely it is. Okay. Well, one of the questions we have is, whether these are senior secured bonds, the opportunity that we have brought for our users. Maybe I can take that one. So Rohit, that's what we have brought for our users is a KrazyBee PTC opportunity. These PTCs are rated A+. KrazyBee is an A- rated entity, and so typically their corporate bonds are also rated A-. Having said that, both the corporate bonds and the PTC opportunity are both senior secured opportunities. And you'll find both of them available on the GRIP platform at different points in time. At the moment, the PTC opportunity will be available, and in fact, there is no other lender in this opportunity who's pari passu. I mean, there's Godrej as a co-investor, but besides Godrej and GRIP investors, there'll be nobody else holding a junior charge. Okay. Raman, would you have any sort of final questions for Vivek before we let him sign off?
No further questions. Thank you so much, Vivek. This was really informative for us. I got to learn something new about your business as well. While we can go through all the analyst reports and all, but hearing straight from you always helps. Yeah.
Hey, thanks, Raman, and thanks, Siddharth, and thanks, everyone. I know it's already late, but thanks for taking the time out and hearing about our journey. We look forward to work with you guys and look forward to help us, the debt raise, what we will be looking in the coming years. Yeah,
absolutely. No, thanks a lot for your time again, and we look forward to seeing you soon.
Thank you. Thanks.
Thanks, guys.
Thanks, everyone.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks, including delay and/or default in payment. Read all the offer-related documents carefully.